Today it's going to be a fairly 101 course. I wanted to do something on how to talk to investors because it's been something that a lot of agents have been interested in. A lot of agents have reached out to me, even on the team lately, just to kind of talk about what we're looking for when we're buying flip properties, things to know. So today we're talking about how to talk about real estate investing with clients. We understand that as new agents, investors can seem daunting, can seem a little bit overwhelming, right? Because maybe you don't know all the terms. You don't know what is a good investment yet. You're still trying to figure out how to find investments. What we're going to talk about today is one, the language, how to explain investment concepts to people that are reaching out, because a lot of the investors that are reaching out to you, they're newer too. Most likely you guys have had conversations with people that said, I want to get into investing, and they're looking for guidance. They're looking for advice. So we're going to talk about some of that language. We're going to talk about asking the right questions. That's one of the biggest things I find when we role play with people. It's pretty amazing. No matter what the scenario is, the newer agents typically always hang up within role play at some point in the conversation. And what do they say? Man, I just don't know what to ask next. So hopefully we'll give you guys some layouts as far as questions to be able to ask to make sure you're getting to the right goals and motives of people. And then how do we help build your credibility? If you've never dealt with investors before, if you've never invested before, what are some terms that you need to know? How can you use those terms to sound like you know what you're talking about, but ultimately know what you're talking about? When it comes to investors, they just want clarity and guidance. They just want someone to go to work for them. So many times realtors do not go to work for their clients. They're not finding the deals. They don't know what a good deal is. They don't know how to comp a good deal. So we're going to talk about a lot of that stuff today to hopefully give you guys some insight to be able to help you out. So why a lot of you guys avoid investment clients altogether? Maybe give me a show of hands. How many of you have wondered, man, I'm not an investor myself, so I'm nervous to help investors out? I'm sure that's some of you on this call, right? There's limiting beliefs. I don't want to sound underqualified, right? Or inexperienced. A lot of you guys, if you're showing a home to somebody, it's not that big of a deal, right? If they want to live there, you probably don't really worry about it that much, right? Do they like the house? Can they afford the house? When you get into investments, it's a little bit different because now you're dealing with people's money. You're starting to talk about numbers. You're starting to talk about returns on investments. Maybe you're not a good numbers person. Maybe you're like, man, I'm not that great at math. I'm not that great at trying to figure out cash on cash returns, right? Or what if I say something wrong? What if I make this person buy a flip and then they lose all their money? So we know that there's some common fears there, but the reality is, what are you already helping people do when they're buying a normal house? Isn't just their personal house one of the biggest investments that most people will ever make? So you're already doing that. So reframe your mind first and foremost. Don't worry about the fact that maybe you don't know all the ins and outs yet. If you're helping people buy their homes right now, you are helping with their biggest investment that they likely will ever have. So you're not starting at ground zero, right? If you're a realtor and you've sold any houses before, you've already done that. Investments are just an extension of this, and we just have to add a few more layers into it. So it's not really that big of a deal. So the earn framework, when we're talking about investments, the first thing we want to do is we want to know simple terms. Let's unmute ourselves if we know some answers. What is ROI?
Return on investment.
There you go. So why do we use that term? And ROI is what? If I put $100,000 into a deal and I make $10,000 out of the deal every year, what is my ROI?
10%.
10%. So it's a percentage a lot of times. It could be the actual amount I'm making, $10,000. Another term would be NOI. What is NOI?
Net operating income.
There you go, right? So if my net operating income is $10,000, that's my NOI. My ROI would be, what is that return on investment I get from the total amount of cash I have in? Another term would be cash on cash return, right? You'll see COC. What is my cash on cash return? So if I have $100,000 in a property and I make $10,000 a year, my cash on cash return is 10%. My return on investment is a 10% return on investment, or $10,000 per year. Now, what happens? I'm going to throw a little harder curveball in here. I own the property for 5 years. I make 10% every single year, but then on sellout, I make another $100,000 on top of my 100 grand that I put in, and on top of my $10,000 a year. What do we call that rate of return?
The compound return?
Close. Yeah, I mean, you are compounding rounding it. It is like the 10% is every year that you're making, but now you're gonna make 100 grand. How much money do you have in that deal right now? You have 100 grand, right? So if I make 100 grand, what's my return on investment on my 100 grand at sellout? Play with some numbers. I put 100 grand in, get 100 grand back. What's my return?
The 100 grand.
Well, it's 100 grand, but what's the percentage? 100%.
100%.
Okay, thank you. All right, now let's get the term, because you're gonna see this, especially when you analyze deals or if you're looking to invest in deals. So if I made 100% back in that 5-year period on my money, remember I held it for 5 years. So now I'm gonna take that 100, I'm gonna split it into 5 years. What was my return per year at sellout? I made 100%, but what was my annual return?
100.
What was that?
20.
Perfect. Now I'm gonna take it one step further. What was my original cash on cash return?
10%.
So now I'm gonna add those two things together, and what am I making per year on my investment after 5 years?
30%.
30% annually. What that is called is your IRR ROI. IRR stands for internal rate of return. If you're trying to learn these terms, IRR is internal rate of return. Because what we know now on this investment is that if Tyler gives me 100 grand and I'm pitching him this deal, I can say, Tyler, I'm gonna pay you back 10% on your money every single year. I'll pay it to you in quarterly payments. So I'm gonna give you 2,500 bucks every quarter for 5 years. And then at sellout, I'm gonna give you your 100 grand back, and I'm gonna give you 100 grand return on top at closing. So your total profit's 150,000 on 100, or 30% annually. We split it amongst 5 years, which means you're making an IRR ROI, an internal rate of return of 30% annually. Does that make sense? Cap rate. So the cap rate is going to be the total return on investment. It would be essentially the net operating income of a property if you were to pay cash for it. I'll explain. If a property is $1 million and I pay $1 million for it and it makes $60,000 a year after all expenses, that is my net operating income. What is my cap rate on that property? I paid $1 million, I make 60 grand a year. What's my cap rate?
6%.
6%. So that's your cap rate. That's if you were to pay cash for the building. But now think about this. If I was to put $250,000 or $300,000 down, so I put 30% down on this building, now I take a loan for $700,000. See, now I'm paying a mortgage. And when I'm paying that mortgage, what happens to my $60,000 in profit, right? It comes down. So this is why it's important to know the difference between a cap rate and a cash on cash return. So when you guys are looking at deals online for investors, if you're looking on LoopNet or Crexy, people want a quadplex or a duplex or a triplex or a single family home, right? You're going to look at your overall income, GOI, gross operating income, total income. Then you're going to take up all the expenses. That's going to be your NOI, your net operating income. And whatever the return is on that would be your cap rate, which means if you paid cash, the cash on cash return is the same as the cap rate. But as soon as I take a mortgage on that property and the mortgage starts eating my cash away, right? I didn't pay $1 million for the property. See, now I have 300 grand in. So what I'm going to make is less than 60 grand. So do you understand how the cap rate is if I just pay cash, then my cash on cash is that cap rate. But if I'm putting a mortgage on the property, it's no longer the return, because now I'm trying to figure out what my return is on my cash. Does that make sense? Or am I confusing people more? Because I feel like this is a very, very, very big, important point when you're dealing with investors and when you're trying to help investors purchase properties, right? Because we have to figure out, is the investor buying cash or are they buying with a loan? See, if they're buying cash, then the cap rate's really all we need to know. Because if someone says, I have $1 million and I'm going to drop it into something that's $1 million, we can look at that cap rate. And if it's an 8 cap, we know they're going to make 8% on their money. But if they say, I have $300,000 and I'm going to put it down on $1 million property, the cap rate means nothing anymore, because now the whole thing is that 300 grand down is the cash that's in. What's the return on that 300 grand cash? Does that make sense? I'm seeing some nods as a yes. I mean, if you can wrap your head around just this today, right? If you can wrap your head around cap rate versus cash on cash return, you will go very far, because this is going to be the biggest thing. Because as we dive deeper into this thing, we start getting into the questions that we're going to ask. We need to be able to do this, right? So here's some of the terms. Now, questions. What's your long-term plan for this property? property. What are you looking for? Are you looking for a cash on cash return? Are you looking for appreciation? Are you looking for a high cap rate? Are you looking for a good depreciation? What's your goal here? Are you looking to live in a property and rent it out for a while? Are you looking to live in one unit and maybe rent the other units out? Are you looking to house hack and live in a house and flip it for a couple years and sell it? So you need to be able to ask these questions to be able to see what is it that these investors are wanting to accomplish, right? And now you can make recommendations. Oh, Nick, yeah, man, if you're looking to put 50, 60,000 bucks into something, I would maybe recommend you do a BRRRR method. What's the BRRRR method? We buy, we renovate, we rent, then we refinance, and then we repeat, right? That's the BRRRR method. If somebody says, hey, I've actually got a decent amount of money, but I need a place to live, hey, maybe we want you a house hack. Maybe we'll look for a house that's decently livable but needs to be fixed up. We'll sell it to you. You can fix it up over 24 months and then sell it and not have to pay capital gain. I'm looking for some kind of vacation property that I can use once in a while but still is going to make me some money. Okay, maybe short-term rentals are going to be the recommendation. And then normalize investing. That's the last piece of this EARN framework, right? Talk about real estate and investing like it's a natural step in building wealth, because it is. Think about how many of your clients you've sold houses to that they live in that have probably bought investments, that maybe have a financial advisor, that are maybe investing in a 401k. How many of your current clients could also be investment clients if you were to normalize investing as a normal term? Okay, alrighty. 3 questions every agent should ask themselves, right? Clarify the goals. What's your goal in this investment? Are you looking for cash flow, long-term appreciation, or both? This is going to reveal why they're focused on monthly income or building equity over time. For me, I want cash flow. I want cash flow right now. I have 301 apartment doors. I want to be able to live off of that income in case something happens to me, or in case I don't want to go to work ever again, or in case the market turns, or in case I die and my wife needs income, right? Some investors don't care. They're buying and they want it for the long term. They know they're building out appreciation. They're paying down buildings. They'll get their money down the line. So you need to clarify their goals. What's the time frame that they're looking at? How long do they plan to hold the property? 5 years, 10 years, indefinitely? Why is the timeline so important to know when you're selling people investment properties?
Because that would affect their overall net from any of the ROIs or the cap rate, depending on how long they're in it.
Yeah, that's a good reason, right? IRRs, remember that internal rate of return. That's going to change depending on whether someone holds it for 3 years, 5 years, 7 years, 10 years. So there's one thing for your annual return, but then your overall return is going to change depending on how long you hold a property. What's another thing you have to think about in the timeline of someone holding
Taxes.
Taxes, yeah, that's true. If it's somebody's going to flip a house or live in it for less than a year, or maybe they just want to flip a rental and turn it over for value add and sell it, yeah, capital gains are going to change depending on how long they hold the property. That's a good one. What's another thing they have to think about if they're holding for 5, 10, or indefinitely?
Interest rates on the loan?
Yeah, so it's the loan in general is what I was thinking, right? Because if they're going to buy something commercially, most likely they're going to be on a 5-year, 7-year, or 10-year term loan, right? So if they have an exit strategy of 7 years, but their loan is for 5, then they're going to have to refinance at least one time in that 7-year period. So that's something to think about, right? Because you're going to be advising them depending on their timelines on what kind of financing they should be getting. Do they just want to do a DSCR loan that's good for 30 years, but it's going to sit on their credit and be one of those Freddie Fannie loans that people can have? Remember, investors on rentals can only have 10 loans in their name if they're going to go the standard Fannie Freddie route before moving over to some kind of commercial product. So depending on what products they're doing, that's a factor you want to think about, especially if someone's doing a value add and wanting to refinance. Eric, you'd mentioned rates. Rates are killing a lot of people right now. They bought buildings 7 years ago at 3.5%, 4%, and all of their refinances are coming due and rates are still 6. So that's tough depending on how big the investment is. That can ruin your cash flow. So you're seeing a lot of multifamily buildings hit the market nowadays because the refinances make no sense. They're not cash flowing anymore. And then figure out what involvement level your clients want to have, right? Do they want to manage it themselves? Are they going to be completely hands off? Are they going to hire a property manager? Do they want to have properties in the area, or do they want to to invest out of the area, right? See, that's going to determine the property type, their location considerations, and then whether property management makes sense. So keep that in mind as well. All right, some numbers. I love numbers, guys. We have to be able to simplify them for people, right? I try to use simple numbers, and you guys should be doing the same thing with your clients. So here's an example conversation. Let's say you buy this duplex for $300,000 and it rents for $3,000 a month. After your mortgage payments and expenses like insurance, taxes, and maintenance, you're looking at roughly 800% in positive cash flow. That'd be about $9,600 per year in your pocket. You'd be making about 12% annual returns on your down payment and your closing costs, which is much better than a savings account. How does something like that sound to you? So you break it down into monthly numbers first and then show the yearly picture. It clicks faster. So what's one way you think you could explain return on investment to somebody without using a calculator or complex formulas? How would you explain it without...
Probably exactly how you did it in doing something with a hundreds value and then like a 6 or a 5.
Yeah, I think that's a great idea. I mean, the more simple you can make numbers, sometimes I take for granted my math abilities, and I should probably take some zeros off of some of my examples to make it easier. But the reality is, yeah, anything that you can do in whole numbers with whole numbers for percentages makes it really easy to break down for people. But you also have to figure out what kind of percentage people want to make. We've talked about this before in Grid. What's a good monthly cash on cash percentage that most investors want to make? And me, a good comment, right? Comparing to what they get in the money market, 401k, CD versus this situation. They're always going to make more in this situation almost. Plus, they're going to get tax depreciation. They're going to get pay downs on their loan. They're going to get appreciation on the property. When you start factoring all that in, it really starts to skyrocket.
And they have more control.
And they have, 100%. They've got a hard asset that, depending on what happens with the market. I mean, I have crypto, I have stocks, I have 401ks. And when I look at everything right this second, it's amazing how volatile it is. It's amazing how unvolatile all of my apartment building doors are. I mean, it is steady pay. You get some vacancies here and there, but the reality is I know I can almost tell you exactly to the penny what I will likely make on apartment doors next year right now. I cannot do that with my crypto accounts. I cannot do that with my 401k. I cannot do that with EXP stock. I don't know. So that's a really good point, Nia, is that it really makes it easy if you're trying to live on said cash flow. All right, key metrics made simple. ROI, what you earn versus what you invested. Remember we talked about that's the cash flow that you're bringing in, the percentage, the cash amount, that 10 grand on the 100 to what you earn versus what you put in. Hey man, I put 100 in, I get 10 back. That's ROI. Cash flow, monthly income after all expenses. So if I'm making 12 grand a year, what's my cash flow? It's $1,000 a month. Cap rate, annual return as a percentage. Remember, that's taking out any kind of mortgage. That's taking out the debt service. So when I analyze buildings online, the fastest way to do it for me is I look at what it says the NOI is, that net operating income. I see the cap rate that's based on that. Maybe it's 7-8% with an NOI of $200,000. And then I factor in what a mortgage would cost me. So when I analyze investments for myself, just so y'all know how my brain works and how I do it when I buy buildings, I would look at that building, I'd see what the NOI is, I look at what the price of the property is, and then I plug it into a mortgage calculator and I get my annual mortgage amount. So if it's $200,000 in cash flow and my mortgage is going to be $150,000, I know I make 50 grand, and then I divide that into my down payment amount to get my cash on cash. That's how I do all of my analysis for all of my apartment buildings to start. Before I start hiring my analysts, before I start really digging deep, I can do a speed run on math. And if it comes out to 8 to 10% cash on cash on that formula, then I start doing my hard numbers, right? And then equity, that's the ownership we build over time in the property. We put our money down, we pay down on the property, it appreciates it. That's the equity for our people. Thank you so much for tuning in to one of our weekly training calls. Obviously, you caught the recorded session, but if you're interested in catching any of our live sessions that we do them typically on Mondays. I'm going to put the link below. So if you want to join any of our trainings live so that you can participate, so you can comment, ask questions, feel free to come. This is for our EXP group that we have here, our Omega group of agents, but it's open to anybody that wants to join, really. So if you're looking for coaching, if you're looking for training, feel free to hit that link below, and we'll see you on one of our live calls.